All right, let's talk about the markets. After a pretty turbulent few days, pretty much everyone is asking the same thing. Was that big, jarring sell off the beginning of something really bad? Or was it, just a lot of noise? Well, in this explainer, we're going to dig into the data and try to find the real signal. So that's the big question, right? Is this a genuine warning that a bear market is coming? Or is it just a temporary dip that's actually a great buying opportunity? To figure that out, we can't just look at the headlines. We've got to look under the hood, into the market's internal mechanics. Okay, so to figure out if we're in a real crisis, we have to start with the most reliable warning signs out there. And that always means we start with the bond market. If there's genuine fear brewing, this is where you're going to see it first and where it's going to be the loudest. So our first clue comes from high-yield bonds, what people often call junk bonds. Now, in a real panic, investors just dump these riskier assets, and their prices absolutely plummet. But that is not what we're seeing at all. They're basically just moving sideways, kind of chilling within a broader uptrend. No major support levels have been broken, so red flag number one, not waving. Next up, we check the bond market's own fear gauge, the MOVE index. A huge, dramatic spike here would tell us that bond traders are panicking. But again, look, it hasn't surged past any key resistance levels. The folks who are closest to the action, they are not freaking out. So our second red flag is also staying down. And finally, let's take a quick look at Treasury yields. The 2-year yield, totally stable. And yeah, the 10-year has ticked up a bit, but it's holding below a really critical resistance level. So you see the pattern here? The usual suspects, the most obvious signs of a coming crisis, are all telling us that things are relatively calm. And that means the real reason for that sell-off has to be hiding somewhere deeper. Okay, since all the traditional indicators are giving us the all clear, it's time to pop the hood and really look at the market's plumbing. The answer isn't about what happened, it's about how it happened. And it all comes down to this really powerful, kind of hidden force that's driven by options dealers. The concept we've got to wrap our heads around is called negative gamma. Now, it sounds super complicated, but the idea is actually pretty simple. It's basically a market condition where the big dealers are forced to become trend followers. Think about that. When the market starts to fall, their internal models automatically force them to sell. When it rises, they're forced to buy. They become this huge accelerator for whatever direction the market's already headed. And this shows that domino effect perfectly. A small drop in the market triggers this automated selling from dealers. That selling then creates an even bigger drop, which, you guessed it, triggers even more automated selling. It's this vicious feedback loop that has absolutely nothing to do with economic news or fundamentals. It's all about market mechanics. So, this hidden force, it explains the most confusing part of that whole recent drop. Why on earth did it seem like everything was falling at once? Well, it wasn't a coincidence. It was a consequence of these mechanics. What we really had was a perfect storm. The market was already in this very sensitive, negative gamma state. Then you add in all of the extra volatility from earnings season. And the final trigger? A massive wave of options expiring on January 30th. This forced the dealers to unleash all that automated selling at the same time, creating a sudden, violent, and purely technically driven plunge. And the damage was everywhere. I mean, it wasn't just tech stocks or the S&P 500. We saw these coordinated drops in Bitcoin, in gold, and in silver, assets that usually move for completely different reasons. When you see everything fall together like that, it's a huge clue that the cause isn't fundamental, it's technical. They were all just caught in the same powerful mechanical tide. This quote just crystallizes the main point perfectly. The sell-off wasn't a reaction to bad news about the economy. It was a structural event. It was caused by automated hedging in a market that just couldn't absorb all that pressure at once. It was a mechanical failure, not an economic one. So, after digging through the bond market and uncovering these hidden mechanics of dealer hedging, what's the final verdict on that dizzying drop we all just went through? The verdict is actually pretty clear. This was pure market noise. It's kind of the price we pay sometimes for participating in such a complex modern market. It was violent, it was scary for sure, but it was not a signal that an economic collapse is coming. It was just a temporary technical distortion. And, understanding this difference is absolutely crucial. A real signal, a real crisis, is driven by the fundamentals getting worse, and you'd see the bond market flashing bright red. What we just saw was driven by technicals, and all our key indicators stayed pretty stable. This was a temporary correction, not some lasting change in the market's trend. And knowing that difference is how you navigate these moments without panicking. So, the big takeaway here is that the sell off was really about the market's plumbing, not a crack in the economic foundation. The forced selling seems to be over, which leaves us with the million-dollar question. Now that this technical storm has passed, where do the markets go from here? Thanks so much for joining us for this explainer.